Awesome. I think we are ready to go now. Thank you everyone for joining us today. We are excited to bring you another REEP huddle on topics that we think are interesting and relevant for people in the real estate investing arena today. So I want to give you a brief introduction of myself, and then we will visit with Victoria Garza Frazier, and she can share some of her background. So I spent 20 years in the banking industry prior to coming into real estate. And my husband, Jacob, had a property management software company that he had in the Dallas area where we lived. He sold it in 2007, and we decided to move to San Antonio. So I retired from banking and we moved here, spent a few years educating ourselves, and then bought a 24 unit here in the San Antonio market that we ran and managed ourselves so we could learn everything about it. And now moving towards today, we have purchased 33 assets in San Antonio, Houston, and Austin, which are our primary markets, about 720 million in assets. And we are also vertically integrated, which just means that we have in-house management company and about 180 total employees that make it their mission every day to put the resident first and provide a great resident experience. So with that, I would like to turn to my co-host, Victoria Garza Frazier, who can tell us a little bit more about herself.
Hi, everyone. Good afternoon. My name is Victoria, and I am REEP's Acquisitions Manager and Capital Events Manager. And I have been at REEP for 3 years. Prior to this, I worked for another multifamily firm in Miami for 2 years. So really happy to be with REEP for the past 3 years. In the last 3 years, I've been here. I've helped purchase 18 properties, adding over 400 million in assets to REEP's portfolio. And then on a day-to-day basis, I'm underwriting and evaluating future deals for REEP, talking with lenders, brokers, and then once we get an acquisition, it's my job to take it across the finish line. So really excited to talk to you guys about the Dead Deal Club today.
Yeah, it's an interesting topic. You know, we are often asked why we buy properties, but we're never really asked about what we do when we pass on a property and when we don't buy it. And so we thought it would be relevant in today's market, since not every deal is working out like it was in 21 and 22, to really learn more about what is the reason that we say no to certain deals. So with that, are we ready, or do we have a little glitch? I think we have somebody on sharing their screen. So we are going to move forward to kind of what have we seen in the last 2 years. So Victoria, can you walk us through some of this great data?
Sure. So looking at 2023, which is very different from the peak of the market in 2021 and 2024, we love to keep data on all the deals that we review, off market, on market. We keep track of it. So we have here our 2023 acquisitions. We reviewed over 234 deals, underwritten about 200, toured 45 properties, and we're able to capture 4. And so on the left-hand side, those are our reasons for passing. So the number one reason, and we'll get into this later in the presentation, is our criteria. And then second is pricing, and third is location. So that's kind of the main reasons why we pass on a potential acquisition. And then looking at 2024, you can see same reasons. So we're halfway through the year. Deal volume has been lower than the peak of the market. I'd say 60 to 70% lower, but we're still seeing deal volume this year. This is just half the year. So we reviewed 103 deals, underwritten 85, and we've toured 28. And we'll talk about those 3 deals that we've captured in a little bit, but you can see that the reasons for passing have kind of shifted. I want to draw your attention to the seller took off market. In 2023, that was 3%, and this year it was 10%. So that could be due to sellers putting the deal on the market, not getting the price that they wanted to get, so they decide not to sell. they either refinance or recapitalize a property, or they decide to extend their loan with their lender.
And if I could add, Victoria, this year, you and Tim and the team have shared that we have been in best and final on 5 deals, 5 new acquisitions. And in the process, as you said, the seller was not happy with what the market was providing in terms of price. And so they pulled them off the market. So it wasn't that the property wasn't a good opportunity. It was that there was a gap between what the seller wanted and what buyers are willing to pay. So I think this is very telling information.
Yeah. You're exactly right. And I think the broker sentiment in general this year is if you don't have to sell, don't sell. So a lot of sellers are heeding that advice and not putting their deals on the market. Okay, so this is in general our REEP acquisition criteria. And I do want to shout out, we have 2 brilliant analysts who help us churn through all these deals and help us evaluate these potential acquisitions. So just want to shout out to Darren and Daniel for being part of the team and helping us out. So one of our first things that we look at is unit count and vintage. So we like 1980s assets or newer, 100 to 350 units. Physical characteristics. So we like to avoid characteristics that are costly to repair. So that includes electrical breakers like stab locks. That's a fire hazard and lenders will make you replace them, which is costly. Older systems like chiller systems and flat roofs we avoid. And then moving down the list, we look at new supply, which has been something that we've really been honing into in the last year. So a lot of new supply around a potential acquisition could put downward pressure on rents. So we avoid acquisitions with a lot of new supply in the area. And then another thing we look at is lender sizing. So on the 4 acquisitions last year and any potential acquisitions this year, we'll utilize agency Fannie fixed loans. And we're just seeing really great terms on that financing. So we look for properties that will be able to obtain this agency financing. And if they're not able to obtain it, we'll pass on those.
And if I can add, Victoria, I think on the lender side, what we're seeing is they are really looking at experience, both from a borrowing standpoint and from an operating standpoint. And I think that's because of the properties that maybe have not done as well. So they are digging in a little deeper, which we welcome. The lender is kind of the second pass underwriting for us. We do our own underwriting, and then the lender comes behind and does their underwriting. So when they give us the seal of approval and say, yep, this is what we want to do, we'll give you a loan on this property, it makes us feel really, really good. So I think that's important for everyone to recognize.
I agree. Okay, so let's jump into some case studies. These are real assets that were on or off market that we've seen in 2024. So you can see this property meets the unit criteria, the physical characteristics, although late 1970s, had pitch roofs, no stab locks, a boiler system, not a chiller system. But it didn't meet our location analysis. So that is crime and headline risk. It also did not meet our criteria for a flood zone. It's in a flood zone. And also the pricing was too high at $107 a unit. For assets around this size in this area, we're seeing around $80K a unit, not $107 a unit. So if we dive into this, you can see where the little star is, that's where the property is located in South Houston. So you see it's technically in a green area, but we do something called headline risk. So we'll search around the property in the property's name, and we'll put shooting, we'll put homicide, we'll put murder, and then you'll see the news stories that come up and you're able to see what crime occurred on that property that the news cycle picked up, which is something that we want to avoid. So this property was on our pass list primarily due to crime and headline risk.
And many times, Victoria, I know you guys have shared that you don't even look at the numbers until you do the crime study. And there's a lot of reasons for that. One, the lender's going to also do this same look for headline risk. They're going to do their search. And if they find something, then there's got to be a compelling reason for it. Otherwise, they have a concern going into the deal. So that is a very, very important thing to look at. And the other is, if you're in an area that has higher crime, you're not going to get the best renter. I mean, these are areas that people will avoid. So as you said, even though the property itself is in a green area, meaning low crime, it is too close to the other areas that are red, meaning higher crime. So I'm glad that you and your team look at this because it keeps us from buying things that later become a problem. So
yes, I agree. And this helps us de-risk a deal by looking at the crime and headline risk. And it also helps us avoid any kind of future problems because our team is going to be on these sites and we want to keep them as safe as possible.
very good point. Austin, let's look at Austin.
Okay, let's look at this one. So when you think of Austin, you don't typically think of flooding. So this was a really great asset. Again, meets our criteria for vintage, units, crime. It's in a green zone, but there's a creek behind the property. So it is in a 9 out of 10 flood zone. So even in cities that are not known for flooding, it's important to check for a flood zone. So flood, it can disrupt our residents and it can be a strain on our property management team. You have significantly higher insurance expense on any property that has a flood zone. And then you also want to avoid any damage to property. So just like we de-risk for crime, we also want to mitigate risk on the flood zone.
And I will add, Victoria, even though we're talking about Austin, Houston is an area that typically people will ask more about. Was it in a flood area? Because Houston is closer to the coast. And I will tell you that one of the questions we ask even today is, did it flood in Hurricane Harvey? And just because that hurricane, the after effects hung over the city for a lot longer and caused a lot of flooding, they released some floodgates, et cetera. And so we always like to ask the question even deeper in the Houston market. All right, let's look at San Antonio.
Okay, so here's our San Antonio case study. Again, meets criteria, crime, headline risk, flood zone, they all check out. But pricing and lender sizing was a reason that we passed on this deal. So going on to the next slide, you can see that the winning bid, the high flyer, came in at 16.5 million. And REEP's top number was 14.5 million. And you can see here in the chart, the return. So at our price, it's very healthy, 90 over 6%. But then at the high flyer number, the returns go to 50% total return. So that is not good enough for our investors. And then also looking at lender sizing, like Arlene mentioned, the lender is like a second check, right? So our loan to value, or the amount of proceeds a lender will give you at 16.5 million, is 52%, which is low. At 14.5%, our number, it was 61%, which is typically where we like to see it. We like to see our LTV from 60 to 70%. So we're kind of tapped out at that 14.5 number, and we were not willing to go up to meet 16.5 million.
And
so this was a pass.
And you may ask yourself, well, how can somebody get to a price that is 2 million higher than our number? What did they do different to make this deal work? Sometimes you have 1031 exchange dollars, so they factor in their tax savings from a 1031 exchange, and so that boosts their return some. But then the second question that as an investor you may want to ask is, what does the underwriting look like? Did they underwrite a lot higher rent growth than REEP did to make the numbers work? And we see that sometimes. I think in today's world, what are we seeing on rent growth? What are we underwriting typically on a property?
So we're underwriting anywhere from 3 to 5%, which is pretty low.
Yeah. In the previous times, you could see as high as 8-10% rent growth, but we know in today's market, rents have declined some. They're coming back. We're seeing that in all the headlines, but we always want to stay conservative and underwrite much lower than what we think we can achieve. And this is definitely a testament to that. And, when a lender, I want to get to the sizing part of it too, because I'm part of some of those discussions when you have them with the lenders. And what we see is they immediately go, oh, if it's sizing at only 52%, the question they have is, are we paying too much for it,
Yeah.
right?
Exactly.
So pricing in general has done some interesting things. At the high point of 2021 and 2022, pricing was 20 to 25% higher than we're seeing today. And that was the prevailing rate. Cap rates were low, interest rates were low. So deals made sense. A lot of people got bridge financing, and so they were able to get higher proceeds on their loans. So it made sense then. But in today's world, we are able to take advantage of 20 to 25% discount. In fact, I think the last 7 or so we've bought, we're at least a 25% discount. So you'll say, well, does that make sense? Why would you want to buy a property that is discounted? Well, there's nothing wrong with the property, right? We'll just say that. It does, we've qualified all of these loans that we've done under agency financing, fixed rate financing, which can be some of the toughest, and then made sense. So we were pretty good, or pretty sure that what we were paying for the property made sense because it sized from the lender side of it for really good proceeds. So all of this comes into play when we're looking at buying a property, and Victoria and her team go through this whole checklist of items to make sure that it makes sense. All right, leases. I like to say that leases is what you're buying. This is the rental income that you're buying. So tell us about this.
Yes, so this is one of my favorite things that we do when we analyze a property is we look at the last 30 leases that were signed. So this is able to tell us what are the trends in rent growth on this property and what realistic expectations can we have of the organic rent growth. So you can see we take the last 30 leases and we compare them to the in-place rents. So we have the last 30 leases, you can see they increased by $61, $15, $36, $10, $34, and $5, $54. So what this shows us is positive organic rent growth, which is something that we look for on these assets because some rents are going backwards. Sometimes we do this lease analysis and they're negative $100, negative $80, even negative $20. So that way you can see what are the rents doing and how can we pro forma them in the future.
Yeah, I think that's really interesting to look at. And this is an extra layer of effort that you and your team take. And I think it's very valuable because we have to stand behind the rent growth that we are putting into our analysis, into our pro forma budget. And this gives us kind of confirmation. If leases are going negative, then you stop and you say, what's driving that? Is occupancy in this submarket lower? What's happening with that? Is it now trending up? What's happening from that end of it? Are there a lot of new properties that have come onto the market? And when new properties come onto the market, they're usually Class A properties. And in order to lease them up, the owner gives a lot of concessions. I saw something at a Texas Apartment Association conference that showed 49% of units in Texas, this is in Texas, now it's spread all over the state, we're offering concessions now. And that's at least an average of 1 month's rent. Wow. So we look at all of this data and we look in that 3 to 5 mile radius in our markets to say, what is driving rents? What is driving occupancy? Because those are 2 key things for the income that the property would generate, right?
I agree.
Yeah.
That's exactly what we do. And the lender will also look at the last 30 lease analysis. That's something that they will do when they're sizing a property for REEP. And I just want to point out, when we look at all of these factors, we don't look at them in a vacuum. We kind of weigh them all against each other. So when we pick, in 2023, it was 4 properties. It is a really good mix of meeting all of these criteria.
That's phenomenal. Well, as we look at the market, let's just talk about the market right now. We talked about prices dropping 20 to 25% from the height of the market, 2021 and 2022. The other thing is let's talk about what is selling today. What are you
Mhm.
hearing about which properties are going to market and sticking, meaning they actually are closing?
Yeah. So one of the big groups that we're seeing that goes on market and actually sells are long-term owners. So these are owners that have owned the properties 20, 30, 10 years. And so their equity is already baked in and they can sell for a profit. And they're very comfortable with the profit that they're going to make in this environment. And they're not waiting for pricing to get better because they will do okay. So that's one group that we're seeing. Another group that we're
Well, if I can interrupt real
Sure.
quick, so you mentioned an opportunity we're looking
Mhm.
at. We can't share any details on today's
Mhm.
podcast or webinar unless you're a REEP investor.
Yes.
So if you're interested, please reach out and we
Mhm.
can put you on our investor database. But in the case of those three assets, they are all long-term owners. So I think
Mhm.
it's interesting that it's living out, it's proving out what you're saying.
Yes, exactly.
Yeah.
Yeah.
Yeah. What are some other reasons things are selling today?
So some other reasons are people got bridge debt in 2021 and 2022. They have a loan coming due that's going to be maturing this year or early next year. So they want to go ahead and they need to sell. So that's another group that we're seeing. And one of the big things that we ask brokers right now is the seller an actual seller? So they could put it on the market, test the market, see what kind of pricing they get. And if they don't like their pricing, they'll take it off the market. But if they are realistic with their expectations of what they can get, that property will actually be sold.
And I think, one of the other things is you're talking about bridge loans,
Mhm.
are maturities. We've all seen the headlines of how many properties are maturing
Mhm.
24, 25, 26, 27, 28. So there are a lot of maturities that are coming due on these bridge loans. And what we are seeing or
Mhm.
hearing is that because interest rates rose
Yeah.
so dramatically, a lot of owners are not able to refinance or get out of
Mhm.
that bridge loan, which is now sometimes at a high rate if they didn't buy an interest rate cap. So in the case of these bridge loans, they have to sell, right?
Yeah.
The lender
Mhm.
is not going to maybe extend them. Some
Mhm.
lenders are really working with borrowers to modify the loan or extend the loan. But in some cases, if the property is not performing, they are not going to extend that loan. They're going to force that seller or the owner to sell. And so those are some of the opportunities I think that you've mentioned we're
Yeah.
seeing.
Yeah, exactly. And more opportunities that we're seeing are loan assumptions. So there's some really good loan assumptions with fixed rate debt that were purchased 4 or 5 years ago on a 10-year term. So they have 5 or 6 years left. Most of them have full term IO, very low interest rates, anywhere from 2.75 to 3.5. So those are really exciting opportunities and ones that we love to see come across our plates.
Yeah, I think going back to the property we bought in Austin last
Mhm.
year, we assumed a loan at 2.75% fixed. There were still 8 years left on the loan and full-term interest-only payments for those 8 years. So when you have a lower debt service like that,
Mhm.
there is less risk to everybody because the loan payment is so low. And two, you have less risk because you're not going to be affected whether rates go up or down.
Mhm.
We're happy at a 2.75%
Yeah.
fixed rate. So we're going to stick with that one. And then, the other thing we always consider is on the
Mhm.
exit. If we decide to sell in 2 years or 3 years, there's still 5 years left
Mhm.
for a buyer to come in and assume that loan. So it will be an attractive property because it has an attractive loan behind it. So loan assumptions, if you can
Mhm.
find them today and the pricing is right, makes some sense.
It does.
Sometimes the pricing is so high that the equity you have to bring to the table might not make sense,
Mhm.
right? So a lot there to balance
Mhm.
in what we're seeing. How about anything else you're seeing in the market?
Some other things we're seeing are new developments. So they were delivered in 2022, end of 2022, 2023, into the beginning of 2024. So we're seeing those, especially for merchant developers, that their business plan was to sell as soon as it was completed or it was stabilized. So those are ones that we're seeing. And those are really great opportunities because you're able to buy them below replacement cost, which
Okay.
is incredible. But those also are more likely to be affected by new supply. So kind of a give and take on those.
Yeah. You have to check the area really closely.
Yes.
Were there, did all the developers have the same idea and they
Mhm.
dropped, 5 to 6 new properties in a general area? And what is that doing to rents and occupancy is very, very important. We've even seen home builders
Mhm.
that are selling part of the development as a build to rent community. Some of that is they are offering incentives. If you watch anything on what's happening with single family homes, these builders are offering incredible
Mhm.
incentives to get people to buy these homes because they're built, they're sitting there. The home developer has to continue to pay a mortgage on what they owe, and so they are offering deals on these properties. But if they built, call it 400 homes in an area, they might not be able to sell them all. So we're seeing some of them come to market as built to rent communities. So that's really, really key. I think, on the other side, what we're seeing is even when we are making an offer on a property, we are sometimes seeing that the loan value is too high, based on what they're wanting to sell it for. Tell us a little bit about that.
Yeah, so when that happens, we see the deal go on the market. They're not able to get the price that is over their loan balance, so they cannot sell. So then it's taken off market and they try to extend, they try to refi, they try to get some pref equity or mezzanine equity, just to kind of help fill that cushion to maybe buy an interest rate cap, if the loan is kind of, what's causing a lot of heartache. But those deals, they they tend to just kind of go off market.
Yeah. And we're seeing both on
Yeah.
and off market deals brought to us. A lot of that is because we are experienced. We have
Mhm.
these great relationships with brokers in the market, and
Mhm.
they come to us and they say, we know you're going to close. So
Yeah.
we're bringing this opportunity to you. Sometimes the numbers work, sometimes they don't. And those that don't end up in the dead deal club. The ones that do, we definitely pursue and hope that it makes it through to closing, because in today's market, that's a little different. I want to talk a little bit about what we're seeing some also from lenders. So lenders are trying to work with borrowers just to not flood the market with a bunch of foreclosures. And so when they can, when it's an operator that's doing okay, they may work with them on modifying that loan. But if it doesn't work out, what we are seeing is some of the lenders are transitioning these assets, these properties, to special servicing. And then they are trying to find somebody to buy them. They prefer not to take that route because they're going to take a loss on that loan. And they have investors behind these loans that are packaged, right? So they're going to trusted operators. We've been contacted by at least 3 for properties that they want us to come in and look at taking over operations, because the current operator has not done a good job and they prefer not to lose money on that loan. They prefer to wait a few years, let an operator like us come in, increase the performance of the property, and therefore, make it more successful in 2 to 3 years when they can recover their loan balance. So we are excited to see that. Not excited to see it from what the borrower originally is going through, but the fact that this is creating some opportunities. Tell us what you're seeing in transaction volume recently. Is it going up, going down? What are you seeing?
So we're seeing it slightly pick up from where it was in the beginning of the year. I think summertime they feel the momentum, right? It's going towards the second half of the year. So if they need to make a decision to sell or market the property or do something, now is the time. So we're seeing slightly more volume than we did in the beginning of the year.
Okay, that's
And
encouraging.
a lot more than last year,
Okay.
surprisingly.
Good, very good. Yeah, we heard a month ago from brokers, we're going to see more, we're going to see more, and you just never know whether that's going to pan out, but it's looking to pan out because we are seeing more properties come to us for evaluation. So
And just to add to that, kind of what we're seeing when we put a deal, when we're bidding on a deal, there are a lot more buyers that are interested in these deals. So last year we'd see anywhere from 3 to 5 to 7 offers on an asset, and now they're getting 15 to 20 offers. So buyers are back. People want to buy more. So I mean, I think that's signaling some more health in the market.
I think so. And, there's a lot of chatter about, are we at the bottom of the market? I don't know that anyone can predict that today. I think you can only look at what are the signals, right? As you said, more borrowers are having to sell. The pricing is lower. So we're seeing people like Blackstone, big private equity firm, come back in the market and buy a lot of properties. So to me, they've got a lot of analysts, they got a lot of team members that are watching these trends also. And if they are signaling time to jump back in, I think we're seeing that. I think we're seeing some folks come back in. Is it the very bottom? Who knows? But if you compare today's prices to, again, the height of the market in 2021, you have to ask yourself, why wouldn't I buy near the bottom or at the bottom? Who knows, right? So that's why REEP has continued to be active and continued to look for the right deals at the right numbers, still using very conservative underwriting.
And you can see how picky we are, right? We see so many deals. We underwrite a ton of them. We tour them. We really do our homework. But, we're picky at the end of the day.
We have to be picky because there's people behind us, our partners, that also want us to be picky on what we buy. So I think that's awesome. Well, we've covered a lot of the data and we've seen questions popping up on the chat. And so we want to take some time to get to those questions and see what is on your mind. So let's see. As a licensed commercial insurance broker for the past 16 years and who writes 80% of my book in multifamily in Texas, all of these criteria are risks and exposures that carriers look at and evaluate when underwriting insurance. You're exactly right, Tara. Thank you for that comment. I and Jacob and our director of asset management were in London. We actually were advised by our broker to go visit the underwriters at Lloyd's of London. Lloyd's is a primary insurance source, providing about $46 billion in insurance on an annual basis. And so we went and spoke to them and we talked to them about how REEP does business, the fact that we are very picky on our criteria on the properties that we buy, flood, crime, etc. And they liked what they heard. And so we saw a pretty significant decline in our insurance after the insurance brokers heard us tell how REEP does business. So you're exactly right. The criteria is key in so many ways. Victoria, you want to take the next one?
Sure. Is your ABC location map produced by REEP or by a governmental entity? So I think you're referring to the crime map, and that is a software program that we use called LexisNexis that's able to tell you about the crime in the area, the heat map.
Fantastic. All right, let's move to the question by Encarnacion. The question is, what is the definition of lender sizing, and is high flyer the name of the buyer? So Victoria, you want to tell us about lender sizing?
Yeah, so lender sizing is when we bring a property to our debt broker and we say, what are the preliminary lending terms that we can receive on this asset based on our pro forma, our 5-year pro forma, the operations of the property. So we send them a trailing 12 financial report, we send them a rent roll, and then we also send them the purchase price. And so they'll be able to tell us how much of a loan can we receive, what will our interest rate be, what will our interest only period be, what is our term looking like. So that kind of allows us to tighten up our underwriting and be more accurate.
Well, and I know, Victoria, right now we are being ultra conservative on the type of loan we're getting.
Yes.
Tell us about Tier 3.
Yes.
What is a Tier 3 loan?
So a Tier 3 loan is, you have Fannie Mae agency loan. So there's Tier 2, which your DSCR coverage has to be 1.25.
And that's debt service coverage ratio.
Service coverage ratio, yes. But a tier 3 loan is a 1.35%, 1.35x debt service coverage ratio. So that is more conservative on the lender standpoint. So you do have a lower loan to value, but you do get better terms in terms of proceeds. In terms of interest rate.
Okay, and we know interest rate right now is key on these deals. The lower that rate can be fixed, the better it's going to be for the life of that loan. So you mentioned high flyer on one of those slides. The question is high flyer the name of the buyer?
So a high flyer is someone that comes in way above the pack. So if everyone is around the $15 million purchase price number, this person is above and beyond that number. So high flyer is just kind of something that we say, someone that goes above and beyond purchase price.
Well, what's interesting, what we've seen of late is sometimes that high flyer, that buyer that comes in with the higher price is able to convince the broker, hey, I can pay more for this property. But time after time, we have seen these properties come back to market because when that person gets in with their lender, when they figure all the parameters of the purchase, it doesn't make sense, right? So we see some of those properties, we call them rebounders that come back to us and we reevaluate them at a lower price. So, okay, Lindsay's asking, are you worried about your properties dropping? I'm assuming you mean your properties dropping in value. So cap rates drive value in commercial real estate. So cap rates did go up. So property values in general went down across the board, but it is property to property specific. So your income drives the value of that property, of your property. So our goal is to try to drive the net operating income as high as we can to prevent value declining too much. And so the other thing is that we are also looking at what deals do we sell, what deals do we hold on to. And as Victoria said, most brokers are saying, if you don't have to sell today, don't sell today. Now, I will say that in February, we closed on the sale of one of our properties. And we did hit a 185 total return. And so the property did do well. And that's why we sold it. We had owned it long enough that we had a lot of equity in the property. We bought it very low. And so it made sense to sell. So,
and I will add that we sold that on a loan assumption. So loan assumptions do command a bit of a premium in the market because of the low rate. I think that rate was 3.82%. So, but that got buyers really excited and they were able to pay a premium.
Perfect. So there are a couple of questions about exit strategies. Somebody's asking is, how do I find out about the exit strategy for something I already invested 5 years ago? Well, you ask the general partner, what is the exit strategy today? Has it changed from when you underwrote it? A lot of things have changed because the market has changed. So I would recommend that you talk to them. Are you planning to refinance the property? Does it qualify for refinancing? Are you planning to hold it longer so that you have time for the market to recover some?
And I will add to that if you're a REEP investor, we do annual updates on every single asset. So that way you are informed of what the exit strategy is.
Very good point. And again, ask the general partner these questions. They should be accessible and they should be answering these questions for you. Here's one specific to REEP. How many properties at REEP Equity are well positioned for a 2027 exit strategy? Well, we're trying to get them all well positioned. I will tell you that. Now, again, it is property by property and depends on when we bought them, how much equity we have in them, and where they're located in some cases, although primarily the numbers are driving that. We are looking at some possible exits in 2027, but it will be property by property depending on how long we've owned it. Is it time to sell? And do the numbers work to give our investors the returns they want? Here's one. Do you have any current properties that you might have to suspend quarterly distributions this year? We're always very transparent and we let our investors know on a monthly basis and then go deeper on a quarterly basis on it. The reason in today's world that you would want to hold off on some of the distributions is that we might be reserving money to buy a interest rate cap that might be maturing. So there are some reasons for some of that, but we have distributed a lot. I wish I had the number. Rebecca Trainer is on. Maybe she can share that with us on what our distributions have continued to be. So when there's cash flow, we will distribute. And there's not, or if there's a reason we're holding money for reserves, we definitely let everybody know what those reasons are. Okay. There's a question about whether we just try to get fixed rates. In today's world, fixed rates makes the most sense. You know, we can still get a fixed rate loan under 6% because of our experience and because, you know, we are a preferred borrower with our lender. So we do try to get fixed rates. The bridge debt world today is very expensive. I think the only reason to get a bridge loan is if the property doesn't qualify for a fixed rate agency loan. And the bridge loan market today is anywhere from 8 to 11% interest rate. So definitely not something we want to do in today's world. Okay. There's a nice comment. What a smart young lady, Victoria. Says we have you working for us as investors along with the rest of the REEP team. Our number one trusted owner investor partner is REEP, Bob and Kathy Lazenby. Thank you so much,
Thank you,
Bob.
Bob, that was really kind. Thank you.
Okay. Let's see. On the properties that you have bridge loan debt, how are they performing? If you're pro forma and have you had to stop distributions? There is one property that we have, and it's because we are reserving for the next interest rate cap. So I'll say that has occurred, but it's for a good reason. We want to have the dollars to buy the interest rate cap when we extend the loan. But the property's performing well enough that the lender has said definitely we would qualify for either to extend the loan one more year. So that's a positive thing for us. You know, when we started to see rates rise, we got out of about 4 bridge loans. And so we only have 3, I believe 3 left in our entire 23 property portfolio. And those properties are in good areas. We bought them well and they're doing just fine.
There was one.
Thank you, Sharon and Dan, for your nice comments on REEP. We appreciate it.
Okay, how long do you typically hold your assets and when/how do you decide to sell? So our typical hold period is 3 to 5 years. And every year we evaluate if it's a good time to sell and if it's a good time to refinance. So that's something that we do on an annual basis.
Yeah, and I know, Victoria, we work with brokers on those too. We ask for at least 3 to 5 brokers' opinions of value. The brokers know what things are selling and where cap rates are. So we ask them to look at our financials on the properties and they give us brokers' opinions of value. Even if we're not planning to sell that year, we like to know what the market is doing. Oh, great. Rebecca responded. Thank you, Rebecca. She said in Q1 2024, we distributed over $1 million to our investors, bringing the total amount distributed to over 75 million for our passive investors. Thank you, Rebecca, for that answer. And I will tell you, any questions that you don't get answered today, please feel free to reach out to Rebecca Trainer at invest@reepequity.com. And she will definitely be on the phone with you or on email to answer your question. Will a replay of this, let's see, will this webinar be sent out or posted to the website? It will be sent out to everyone that registered, and we will have it available in our reepequity.com website. Go there and look for resources in our knowledge center. Anything we've put out educational, including this, will be there.
And if you haven't joined our investor network, that's the best way to keep up with us and hear about webinars and REEP huddles like this to learn more.
And thank you, David, for your positive comments. You have been a longtime investor with us, you and Ellen, and we appreciate your support as always. Okay, here's another question. Do you all ever do funds or are all single assets? So we have, we raise funds on an asset by asset basis. However, we have done 4 different transactions where we bought 2 properties at a time and bought them as a portfolio. But we did raise for those together as a single purchase. Let's see, please answer if you had to pause any of your current distributions. I did answer that earlier. We did in the case of where we are reserving to buy an interest rate cap. So the property itself is doing fine, but to be conservative, we have done that to remain cautious on making sure we've got reserves for that. Rebecca also answered that question. Thank you, Rebecca. Is there a question if we've had a capital call? Oh no, let's see, we've had Tara saying she's had a call with Rebecca and asking if she's on the portal to receive deals. So Tara, definitely reach out to invest at reepequity.com and we'll make sure that you are on our investor list. So I think we have caught all of the questions that are here. And Brian, thank you. We love educating our investors. We think it's important. The more educated you are, the better decisions you can make. And that is very important when you invest your hard-earned money. So thank you for sharing that. As I mentioned earlier, it looks like we've come to the end because we've answered all of these great questions that you all had. And it's about 12:47. We don't want to keep you any longer than we need to. But if you have additional questions, like I said, please join the network, Investor Network. You will learn a lot more about what we are doing and what we have coming up in terms of opportunities. So thank you for joining us today. We have enjoyed having you as guests. And Victoria, thank you for sharing all your wonderful knowledge with us. We have worked well together. And just a little secret, Victoria is our daughter. Jacob and I are very fortunate that our 2 kids, Victoria and Jacob II, have joined us in building a legacy business. We invite you to be part of that. Thank you and have an awesome day.
Thank you, everyone.